All right, in this lesson we're going to talk about two topics. The first topic we're going to talk about is double entry accounting. So what is double entry accounting? Well, double entry accounting follows the rule or the principle of duality. Now, the principle of duality is that every economic benefit has two aspects. Okay? It has the giving something up aspect and getting something in return aspect too. Okay? Now, we can look at the principle of duality and we can look at examples like effort and reward. The more effort I put into something, hopefully I'll be handsomely rewarded in the end. We can also look at sacrifice and benefit. So if we look at time, we're going to sacrifice our time now to get a benefit hopefully later on. Okay, because we can't be in two places at once. Okay, so principle of duality kind of tells us that we've got to do two things when a transaction happens in our accounting books. Okay, now in accounting we have duality, and that duality comes in the form of what we call debit and credit. Okay, now here's a sore point for a lot of students who are taking accounting for the first time. There is already a notion of what debit and credit means because of life. Okay? So if I ask someone who's never taken accounting, never had business experience, what does debit mean? What's the first thing that comes in your head? A lot of times debit means down. Okay? That's what people tell me. Down. And then I say, okay, what about credit? Well, what I hear often is up. Because if I'm making money and my employer pays me, they're going to put money in my account through direct deposit, and they're going to credit go up my account. Okay. The one thing that I want you to understand when we're talking about accounting is that debit does not mean down, credit does not mean up. Okay. So once again, when we're talking about accounting, throw out the idea of debit means down, credit means up, and think about debit meaning something totally different and credit meanings totally different, something totally different. Okay, so let's go back. What does debit mean? Well, in accounting, debit only means left. And for credit, it only means right. Again, sore point. A lot of people think debit, down, credit, up. In accounting, debit, left, credit, right. That's all it means. Okay? So I always joke with a lot of students and say that, if you're in the passenger seat, you could technically give directions using debits and credits. So if I said, go down the road at the stoplight, make a left, okay, you could technically say, go down the road, go to the stoplight, and make a debit, which means left, okay? So debit means left, credit means right. How did we get to that point? We got to this point because of something called a T account, okay? Now, before technology happened, we had these T accounts that we would summarize all of the accounts. So remember, we had these categories. Within these categories were accounts. So we would summarize them into these T accounts. Now, each account would have their own T. So if we had 50 accounts, we'd have 50 T accounts. So let's think of service revenues. Okay. Let's assume that we receive $3,000 in revenues because we did a job and we received it in cash, hopefully. So principle duality says because we received $3,000 in cash for revenues for something that we did, we need to book it into our books, and we're going to hit two accounts, duality, two accounts. The question is what side of that T does it go on? Okay. Now, if you're putting two together, debit and credit. Okay, so this left side right here is called the debit side. Why? It's on the left side. This right side over here is called credit. Why? Because it's on the right side. Get the point? Debit only means left, credit only means right. They don't mean up or down. Okay? So the question is this $3,000, where does it go? Does it go on the left side? Does it go on the right side? Does it go on the debit side? Does it go on the credit side? Okay. Now, as I erase this board, I kind of want to tell you why we're learning this and why we're putting all of this together. We're putting all of this together because in normal accounting classes, in normal textbooks, we often learn the debits and credits to each one of these categories individually. And I found that it might be better that we learn it all as a whole, and it would make students understand debits and credits a little bit better. Okay, so this is how we learn debits and credits, and this is how we learn our 6 categories. Okay, if an asset, expense, or dividend account, okay, those are categories. So if it's an account, it's cash, rent expense, dividends, dividends. Then if it increases in nature, we are going to debit that account, which is the left side. If it decreases in nature, we are going to credit that account, which means right side. Okay? The opposite is true on the right side of the equation. Okay? So if it increases in nature and it's a liabilities owner's capital revenue account, then we are going to credit that account, which means right. And then if it decreases in nature, then we're going to debit, which is left. Notice I'm already breaking the rules over here. Okay? We said that, debit for most people thinks down. Well, I'm telling you over here that if it's an asset, expense, or dividend and it increases in nature, it is not a credit. It's a debit. Okay? And so that's how I want you to understand it. Like I said, in normal textbooks, they'll start with assets and then they'll tell you this. And they'll go to liabilities over here, and they'll tell you this. And then they'll go to owner's capital, they'll tell you this. Then they'll go to probably revenues, and then expenses and dividends. So you're going to learn it 6 different ways. Okay? 6 different ways. Here, I'm going to try to give it to you all at once. If you know this and you know this, then it makes it easier to know the debits and credits. And this is a sore point for a lot of students when they're trying to understand accounting for the first time. Now, let's go back to our example here. $3,000 in revenues, and we received it in cash. Where does it go? So let's start with our T accounts. Now remember, I said that in the old days, before we had technology and software that could do this for us, we would have T accounts for each one of the items. So we have cash, and then let's put over here revenues. Okay. Now, let's start with revenues since that's what we got it for. Revenues is a revenue account. Now, this could be called a service revenue, so just so that we don't get confused, let's call this service revenue. Notice service revenue is a revenue. Okay. Now, what happened to that revenue? Well, it increased in nature because I had more of it. Okay. Now, this always gets students confused, but I always think about it this way. Revenues, dividends, and expenses are kind of like a scorecard. Okay. Kind of a scorecard in sports. If we have more of it, we increase the scorecard. If we have less of it, we decrease the scorecard. So if we spend more money, then we're increasing expenses. Okay? If we're paying out more dividends, we're increasing dividends. If we're receiving more revenues, we're increasing revenues. Okay? So service revenue is a revenue account. We said that if a revenue or the scorecard goes up in nature, we're going to credit the account. It's going to go on the right side. Okay, so $3,000 goes on the right side because it's a credit. Credit increases of our revenue goes on the right side. Okay, now let's talk about cash. Okay, we received $3,000 in cash. Because we received $3,000 in cash, our asset, cash is an asset, increased in nature, and if it increases in nature, we're going to debit the account. Notice both of these are increasing in nature. However, they have different things happening when it comes to the regular T account. So increasing debit, debit means left. We're going to put $3,000 here. Principal duality says we have at least 2. We've got 2. 1, 2. We're done. Okay? So that's the debits and credits. Now, where does this come full about? This comes full about because we need to know where to put it. Now, in the real world, we put something called journal entries together. And so when we put journal entries together, we wouldn't put it in these T accounts, but we would journalize them into an entry. So what are journal entries? Journal entries are a set of entries that we put together. So let's use this example here. We would have debit of $3,000, credit of $3,000. So the way that we would write this, cash of $3,000, credit service revenues of 3,000. Okay? So we have cash of 3,000, service revenues of 3,000. That's our journal entry. Notice this is more compact than that. That's why we do it this way, and that's why you need to know your debits and credits. Okay, final lesson, we're going to talk a little bit about these journal entries. How do we put them together? What happens, and what you need to know when it comes to journal entries after you've known this.